and today we're going to talk about stock and option spread trading, and we've been using these strategies for many years, and the spread trading has really worked out well over the last 2 years, where the markets in general have not really trended well over the last couple of years, and a lot of volatility in between. So it makes it very difficult to make money on directional trades. So we're going to talk today about our spread trading with stocks and options, and that works a lot better in the current market environment where we have very little trend and a lot of volatility and a lot of sector rotation. So we'll discuss the advantages of option spreads versus directional trades. And of course, when you buy a stock, it must increase in price in order to profit. And when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll incur 100% loss of the option premium. So when you're trading options and you buy a call option, let's say, you're always faced with the possibility of 100% loss of that premium. Here's I took a snapshot of Facebook option chain recently. Facebook was trading at 132.07, and if we were going to buy the 135 strike call, this option is about 1 month out. So if we're going to buy the 135 strike call, we'd pay $3.15 to buy the 135 strike call. And at option expiration, in this case about a month out, Facebook stock, the underlying stock, would have to close above 135, which is the strike price of that call we looked at, or you would incur 100% loss of that $315 premium. So when you're trading options, you're always faced with that possibility of a 100% loss. And our screening program that you'll see today, the goal of that, of course, is not to incur those big losing trades when you trade options. Otherwise, you can really get knocked out of the game pretty quickly. So here's a daily price movement of the S&P over the last couple of years, and as I mentioned, not much trend, a lot of volatility. You can see all these declines here. You know, if you entered a call option trade and your timing was bad, you could easily get stopped out in this kind of a market. So that's the disadvantage of directional trading. This is the daily price movement of the VIX index, which is kind of like a mirror image of the S&P. Every one of these spikes you see here represents a sell-off in the stock market. So if you were long a call option during any one of these sell-offs, which is represented by these spikes, you could easily get stopped out of your position. So we like to trade stock and option spreads, and a stock spread can profit if the stock increases in price, decreases, or is flat at option expiration. So that's a big advantage over just a directional trade that the stock has to increase in price or you lose money. And with option spreads, they can profit if the underlying stock increases, decreases, or is flat at option expiration. So that's a big advantage over directional trades, when you can profit if the stock is up or down. So let's look at our Prime Trade Select system. We use this system to select stock and option directional trades. We'll look at our trade selection first, and then we'll look at some examples of directional trades we took. And then one of our money management rules is when we have a profit in a directional trade, then we create a spread trade. And that's really worked out well the last couple of years, because these spread trades have been profiting during this type of market condition. So once we enter a directional trade, whether it's a stock or option directional trade, we have 3 money management rules. The first rule is we exit losing trades quickly before they turn into a large loss, and we don't exit winning trades with a small gain. So that's also an important part of trade management. You know, as soon as you get a gain, a lot of people want to take it, but you don't want to take you don't want to exit winning trades with a small gain. And then, of course, we use options to protect profits. When we have a profit in a directional trade, we use options to protect those profits by creating a spread trade. This is just a recent listing of some closed out trades in our option portfolio, and these are for Apple, Amazon, Home Depot, Netflix. And what I did was I calculated the average losing trades that you see here versus the average winning trades. And the average losing trade in this portfolio of closed out trades was a 14% loss. And we like to exit our losing option trades before we incur a 20% loss. So in this example, we had an average loss of 14% on our option trades, but our average winning trade was 136%. So we don't exit when we have a small gain in an option. We'll hold on to it. And on the other hand, if we have a losing trade, we'll exit that quickly before it develops into a large loss. So in this case, our average loss was 14%. So those are just examples of our money management rules in action. And in this example, we only need to win on 1 out of every 8 trades in order to profit. So because our winning trade, 136%, average winning trade was so high, we only need to win on 1 out of 8 trades in order to profit in this example. So if you incur a 20% loss on an option, it takes a 25% return on your next trade to break even from that trade. But if you incur a 50% loss, it takes a 100% return on the next trade just to break even. And how many 100% winners have you had lately? So the point is with this money management is to cut your losing trades short pretty quickly and to let your winning trades run. And of course, if you incur a 75% loss on your option, then you need a 300% return on your next trade just to break even. So if you limit your losses on an option trade at 20%, you can survive and then move on to the next profit opportunity. And we normally use, for a stock trade, we'll use a 5 to 7% stop loss. And with an option trade, we look to start getting that out to exit the trade with a 15 to 20% loss on the option. And whenever we have a profit in a stock or an option trade, then we use options to create a spread trade to protect profits. And stock spreads, there's 2 types of stock spreads. We'll show you examples of that in a minute. With stock spreads, you can profit if the stock increases, decreases, or remains flat. And with option spreads, you can also profit if the underlying stock increases, decreases, or is flat. And establishing a stock trade, stock spread trade, can even guarantee that you'll have a profit for your stock trade, and establishing an option spread can even guarantee a profit for your option trade, and we'll show you some examples of those.
Chuck, I'm
Yes.
sorry to interrupt. We do have a quick question. Sister White is asking, is your 20% loss stop on directional trades or on your credit spread trades?
That's a good question. It's on the directional trades.
Okay, thanks, Chuck.
Yep, okay. And okay, so we'll look at actual trade examples that demonstrate how a spread can guarantee a profit for your stock or option trade. So we actually trade these spreads. I can show you examples of trades that we took, both stock and option trades that we took, that were guaranteed to have a profit on the trade no matter what happens to the underlying stock.